was an internet issue.
So can you see me right now?
Yes, sir.
And can you see what can you see right now?
Just a background behind you.
Just the background behind me. Okay. Uh, uh, now can you see the presentation?
No. Yes. Now I can see it.
Okay. So in the case of equity, there are two ways to finance a company. One is ordinary shares and the other one is preference shares. In the case of ordinary shares, what do you pay to your shareholders? You pay dividend to them. And the dividend is your cost of financing a company using ordinary shares. Whereas if you finance a company using preference shares, you have to pay the people who are financing you using your preference shares, you have to pay them preference dividends. That preference dividend is your cost of financing a company using preference shares. In the case of debt, there are two ways to finance a company using debt, either loan notes or debentures or bank loan. In the case of loan notes or debentures, you have to calculate the interest cost. That is calculated using KD 1 minus T.
Okay.
And in the case of bank loan, the cost of interest is denoted as KB. So basically, why do we write KE, KP, and KB? But in the case of KD, we write KD 1 minus T. That is because in the cases of loan notes, debentures, and even in bank loan, okay, because the bank loan cost is given to us, we have denoted it as KB. But while calculating your weighted average cost of capital, while calculating back in your exam, you will be writing KB1 minus T and KD1 minus T because interest is taxable. It gives you a tax benefit. So that is why we use KD1 minus T and KB1 minus T. But in the case of dividend, in ordinary and preference shares, it is not taxable. It is not a tax benefit, and it does not give rise to any refund from the tax authorities. That's why we write only KE and KP. KB is always given in your exam. KE, KP, and KD are needed to be calculated in your exam. WACC, on the other hand, is the weighted average sum of all of the above. So basically, cost of capital in equity is ordinary shares KE, preference share is KB, debt, loan notes, debentures KD multiplied by 1 minus T, and bank loan is KB. Now, first one, preference shares. Preference shares cost is calculated using KP is equals to PD over PO, in which KP denotes cost of preference shares, PD denotes preference dividend, PO denotes market price of preference shares. When I'm saying PO, it means P naught, which is market price of
Not
preference
market
shares.
price of shares.
Tax rate in this case is not applicable in cost of preference shares because it is not taxable. An example can be if there are 8% preference shares in your company at a par value of $1 with a market price of $0.8. Your KP will be 8% multiplied by par value because dividend and interest is paid on par divided by your market price, which is 10% in this case. Now, cost of equity for ordinary shares. Cost of equity is denoted using KE. It is calculated using either of the two models, either capital asset pricing model, which is in short form written as CAPM, and dividend valuation model, which is in short form written as DVM. It is the cost that the business will incur if it raises funds using your ordinary shares. Capital asset pricing model. It is based on the relationship between your systematic risk and your expected returns. The formula to calculate your KE using CAPM capital asset pricing model is E is equals to RF plus beta equity multiplied by RM minus RF. E is your cost of equity, which can also be written as KE. RF is the risk-free rate, usually the government bond rate in a question. RM is the market rate of return, and BE is your beta equity. The key terms here are systematic risk. It's a market-wide risk which can be either inflation, interest rates that cannot be diversified away, which means that you cannot divert your company or yourself from these risks. It is there, it is present, and you have to face them.
Take them into
Uns-
account. Yes.
Unsystematic risks are the company specific risks, such as strikes, bad management, that can be eliminated or diversified from portfolio, which means you can divert yourself from that risk. Those are known as unsystematic risks. You can divert away yourself from them, you can hide from them, but you cannot hide from the systematic risks. The theory behind CAPAM is it assumes that investors are well diversified and therefore they only needed to be compensated for the systematic risk. Dividend valuation model. It is based on the theory that the value of share is the present value of its future benefits of future dividends. Basically, it means that the value of a company's ordinary share is the present value of its all the future dividends. The formula is RE is equals to DO multiplied by 1 plus G divided by P naught plus G. What this formula shows you that your next year dividend divided by your current market price plus the growth rate is the cost you will incur, is the rate of the cost that you will incur if you finance your company using ordinary shares. In this, RE is the cost of equity, D naught is the current year dividend, P naught is your current market price of the share, G is the growth rate, and D naught multiplied by 1 plus G can be replaced by D1, that is also known as the next year dividend. Sometimes in your question you will not be given the present year dividend, you will only be given the next year dividend. So you can use that next year dividend and skip the D naught 1 plus G. Theory. It assumes that dividends grow at a constant rate, that is G, forever. Basically, if you use the DVM, you accept the fact that your dividends are growing at a constant rate for your lifetime. And the limitation is it does not explicitly consider the risk and assumes the historical growth rate will continue. Because in the case of DVM, you assume that the dividends that grew with by the rate of 10% 5 years ago are still going to continue growing for 10% for the next upcoming life, even if the things change, even if there's a risk of historical or unhistorical events, even if there's a risk of systematic or unsystematic matter, explicitly it explicitly does not consider any risk or any other thing. It only considers your historical growth rate only. Cost of debt. Cost of debt or KD is calculated either using three models. If the debt is redeemable, which means the maturity period is set, then we use IRR. IRR is internal rate of return. What you do in this case is you take your cash flows of the debt and you calculate two NPVs, one at a lower rate and one at a higher rate, and then you use the IRR formula to calculate the IRR at which your NPV of those cash flows will be zero. That rate is your cost of debt. In the case if the maturity period is set, but the debt is convertible to an equity instrument, then even you use IRR. In this case, you calculate the cash flows from the normal bond and you calculate the cash flows if it's redeemable and if it is converted into an equity instrument. You calculate, okay, where the cash flows are higher, in which case you're getting the more benefit, and if it's the convertible or redeemable case, you use the IR formula as the same as it was in the redeemable method. If the debt is irredeemable, that is, the maturity period is not set or at an indefinite time, then cost of debt is equals to I divided by P naught, where I is the interest amount and P naught is the current market price of the debt. In the case of KD, you will always use KD1 minus T, which means in all these calculations, if you use your pre-tax cash flows in the calculation of IRR, then it will be KD. And if you use your post-tax cash flows in calculating IRR, that will be KD1 minus T. In the case of irredeemable, the way the formula is written, whenever you calculate, it will always be pre-tax cost of debt. You will have to multiply it and calculate the KD1 minus T, that is post-tax cost of debt. Now, the most important part, capital structure theories. These theories discuss whether changing the mix of debt and equity, that is the gearing, affects WACC and the total value of the firm. So basically, here in capital asset pricing model, the title suggests capital asset, which means you have to use your capital and your asset here, and you're calculating a pricing model using your capital and your asset. And in the case where your beta equity is not given, what can you do? Can you tell me what can you do?
We have to calculate the beta equity by its
Yes.
formula.
Yes. You have to calculate your beta equity using your beta asset formula, that is beta asset is equals to beta equity multiplied by market value of
Beta
equity
debt.
divided by
Yes.
market value of equity plus market value of debt by 1
Okay.
minus T,
Minus
bracket
T.
close, plus beta debt, and the same way. Basically,
Yes.
your beta asset is the sum of weighted average of your beta equity and beta debt. Hey, I have shared the formula and I have shared an easy way, and I've also shared how you can use this formula and how you can actually calculate your beta equity in a very stress-free manner in my live classes, in my classes on the LMS. But I'll also share the same thing at the end of this lecture with you while we solve the question. Now, capital structure theories. Basically, in your syllabus of weighted average cost of capital, there are four capital structure theories that are involved. There are basically four theories of capital structure that are involved in your syllabus. The first one is known as the traditional view. The theory here is there is an optimal capital structure where WACC can be minimized. Basically, your WACC is a weighted average sum of all the cost of all your sources of finance. Obviously, there will be a way that you can reduce your WACC as much as possible by changing your capital structure mix, which means by either increasing or decreasing your equity value and increasing or decreasing your debt values. There will be a certain, mix at which your WACC will be the lowest. The traditional view theory basically says that there is an optimal mix of capital structure where WACC can be minimized initially by replacing the expensive equity with cheaper debt, because equity rate will always be higher, because whenever someone puts money in your company and they have no guarantee that they will either get their funds back or not, they will obviously be asking for higher returns. But in the case of debt, the return of funds is guaranteed by the company, So in that case, their asking rate will always be lower. So in that case, the debt is always a cheaper way to finance your company or finance your business compared to equity. So when you replace your expensive equity with a cheaper debt, you lower your WACC. However, at a high gearing, the risk of bankruptcy increases, causing both cost of equity and cost of debt to rise sharply, which eventually then increases the WACC. Because obviously, always remember, debt is good, but higher debt is not good. Equity is good, but lower equity is not good. You have to have an optimal mix of both the things. You cannot just rely on simply one thing or simply the other thing. You have to keep an optimal mix. So when debt is introduced into a capital structure, WACC falls due to the benefit of cheaper debt. But this is for only a short period of time, because at a higher gearing, WACC starts rising, but at a very higher gearing, WACC shoots up. Therefore, a company should increase their debt till a certain level and maintain it then. Pecking order theory. What pecking order theory says is that firms follow a hierarchy of financing, not an optimal mix. So basically, pecking order theory is totally against the traditional view theory. It says that that a firm or company never follows an optimal mix or never calculates an optimal mix. They always follow a hierarchy, or you can say an order of financing a company. And in the pecking order theory, the order is: first you use retained earning because it is cheapest and there is no issue cost. Then you use debt, and then you use the more new equity, which is the most expensive or the last resort. Yes, now Modigliani and Miller, M&M, Notex. So basically, M&M, Modigliani and Miller, they were two theorists, and they suggested in 1958, they suggested that capital structure is irrelevant, is of no use, it is of no good, and and in a tax-free world, value of a geared firm is equal to a value of an ungeared firm. Investors are rational and cost of equity is directly proportional to increase in gearing. Increasing cost of equity exactly offsets the benefit of the cheaper debt, and the WACC remains same, so the company can keep an average mix of debt and equity. So basically, what do they say? They say that the benefit of cheaper debt is offsetted by the expensive cost of equity, and due to an increased financial risk, the WACC always remains the same. What they mean is that in a tax free world where tax does not exist, where tax is of no good or no use, you do not have to rely on an optimal capital structure. You can increase your debt as much as you want, but then you have to increase your equity as well. So that, but when you increase your debt as much as you want, your equity also increases. So the cheaper debt is offsetted by the expensive equity. Whereas in 1963, exactly after 5 years, these two theorists changed their view about the world, and they said, okay, with the tax world, value of a geared firm is greater than a value of an ungeared firm. Investors are rational and cost of equity is directly proportional to increase in gearing, but since debt attracts the tax saving in tax benefit, then the WACC falls. So the company should be 100% geared. So basically, what they meant was that you can increase your debt as much as you want. You can even use 100% financing from the debt. You can ignore the equity and you can throw it in the trash, because when you use debt as a financing, you get cheaper rates, but And because of those cheaper rates, you also get tax savings from the interest costs of those debts. And due to the tax shield, that is interest being tax deductible, that is so cheap that it outweighs the increase in cost of equity, and the WACC falls as gearing increases. Which what they mean is that when you increase your debt, your WACC falls. But that is not true, because when you use debt, your risk increases, and because your increases, your risk profile increases, your risk profile gets higher and higher, and that is why you fail in getting cheaper rates of interest, and then your WACC increases. Okay, guys, that is all for the revision session. Now we'll be moving towards the Q&A, and then we'll solve a full-fledged question and a few MCQs.